episode of Conversations with a President. I'm your host, Erica Lamb, 2020 Reno Sparks Association of Realtors President. Today I have three guests from the banking industry to talk about opportunities for current homeowners and their mortgage options. Before we get started, I need to let viewers know that the information provided by our guests today are for informational purposes only and do not represent other banking and mortgage institutes. For specifics or questions about your options discussed today, you must reach out to your lender banker to determine what options are available to you or your clients during COVID-19. With that being said, let me introduce our guest today. We have Nick Serrano, Vice President of Mortgage Lending of Greater Nevada Mortgage, Affiliate Director for the Reno Sparks Association of Realtors, and longstanding partner with the association. Welcome, Nick.
Thank you for having me.
Then we also have Andy McGinnis, AVP Home Loan Officer of Umpqua Bank, and also a longstanding partner with the association. Welcome, Andy.
Thank you. Happy to be here.
Thank you. And then we also have Samantha Gomez, Managing Broker for Welcome Home Funding. Welcome, Samantha.
Hi, happy to be here too.
Thank you. We have a lot of information to cover today, so let's jump right into our questions. Nick, would you start us off by giving us insight into refinancing options for homeowners during COVID-19?
Well, I appreciate that, Erica. First and foremost, let me stress that the industry is financing home loans. In a time where it can be difficult to keep track of what industries are doing what and to what extent, I want to stress that the simple question is yes, to our lenders funding loans. And the truth is, we're doing that at a record pace as an industry relative to refinancing, as dynamics that impact refinances remain in play, and that is appreciation and equity in people's homes that have grown rapidly, certainly in this market, combined with a low interest rate environment, produce an ample amount of opportunity for people to take advantage of refinancing and improve their financial situation through that regard. Some flexibilities have been added to what we can do. There have been some inherent restrictions though as well. For example, with appraisals, not everybody wants someone in their home, and not every appraiser wants to go into a home, and under certain refinances, there's still requirements around those. But again, everyone's situation is different, and the primary thing is just to look for that trusted lender, let them walk you through their options, and see if a refinance will help improve your financial situation right now. But with that, let me turn it over to Andy for his additional insight.
Thank you, Nick. Yeah, what we're seeing is an influx of refi business quite a bit. Usually I have more on the purchase side, and right now it's just the opposite, which is, hey, great for us. But like you said in the beginning, we're open for business. Umpqua and all of you, we are moving, we are funding loans at a record pace as well. Regarding the appraisals, agreed. On a lot of these files that we're getting exterior only, or we're getting waivers in regards to those appraisals. So it's always nice to see those, and it alleviates a lot of stress on the side. With that, I'll pass it on to Samantha.
And just to piggyback off of them, you have lots of options when it comes to refinancing. So it's not necessarily a necessity for you to take cash out. If you don't want to take cash out, you could use it just to take advantage of low interest rates, lower your payment a little bit, but then also know that you have some time built into that refinance. So you could go a month or potentially 2 months without making a payment.
Okay, let's move on to the next question. Andy, would you lead us off by giving us some insight and information on forbearances?
So there's been a lot of talk about forbearance, and essentially what a forbearance is, it's a reduction or a suspension in the payments on a mortgage, and so, or in regards to a loan. So what happens is that right now we have people that are coming into the bank and saying, hey, because of the hardship, and it's treated as a disaster through the government, and so it's not affecting the borrower's credit over this time, which is different than back in back in the other days, back in 2006 and such. When it comes to the forbearance, these payments are put off, so they don't have to make the payments for 30, 60, 90 days. Actually, they can request a forbearance up to 180 days and then get an extension of an additional 180 days. At that point, after a certain point in time, they are going to come back to the borrower, and hopefully the borrower is back gainfully employed, making money and able to make the payments. And at that point in time, it's generally requested to find a way that the borrower is going to repay. A forbearance is not a forgiveness, that the money is still owed, and there's different options at that point in time. So say 90 days down the road, if the borrower still has a hardship, it can be requested, a hardship letter can be requested, and it will be determined between the circumstances of the borrower and the investor as to what would be the appropriate turn or the appropriate action to be made at that point in time. Borrower can pay it all back in one lump sum. There's no problem with that. But if you haven't paid your mortgage in 3 months, and then all of a sudden on the 4th month, you have to come up with a lump sum of that, there's not a lot of people, or maybe that would be an extreme challenge. That's not the requirement that is going to be made at that point in time. Each borrower is different. All the circumstances are different. And so they'll have to discuss with the servicer at that point in time what the appropriate action to be taken is. Umpqua's position in this on the forbearance right now, there's no questions asked. If the borrower comes to us and says, hey, I'm having trouble making my payments because of the coronavirus, it's on. Basically, we're providing that. We're not, telling them, hey, do you know what the ramifications are? They need to look out. They need to review. And there's been some good articles that have come out from the CFPB, which I'll include later on to you guys. But with that, there are more options, and I can go through, but I'll pass it on to Samantha at this point.
I thought you did a really great job explaining that. Actually, I don't have a ton to add. The only thing I just want to highlight on and kind of play off of what you said is you do want to make sure that you're asking the questions and you're making sure that you get the information from the servicer. So, for example, I have gone through and helped a few clients of mine go through this process. When you call the number on your mortgage statement, it's probably going to be an hour-long wait because there are a lot of people calling for this type of assistance. And there are several companies, several servicers who are requiring, if you do that forbearance and you forego the payment for a couple of months, that lump sum payment is then due and payable. I know a few of the servicers that we have 2 servicers we use, that is what they're requiring. Will that continue to change? Yes, but I know that a lot of them are requiring that. So if you do forego this payment, it's possible that you will have to make that full lump sum payment the next month. So we could skip a $1,500 mortgage payment this month, and we could skip a $1,500 mortgage payment the next month, and then you will have that $3,000 payment due. Again, like he said, it's going to be different for everybody. So that's why it's important to just make sure you know what you're getting yourself into. And you can always ask us. Passing it off to Nick.
No, I appreciate that. And, we are going to be a little bit redundant on this panel. Sometimes redundancy is annoying, but sometimes redundancy is important because there's a few things we really want to drive home to the viewers of this. But before I get into that, I want to stress that servicers have loss mitigation tactics. We were already prepared to help people. So when the CARES Act came out, they came out with flexibilities or enhancements to things we already know how to do, and we already know how to help people. So, I want viewers to understand this isn't a new thing for us in the industry to say, here are the options. We're not learning this on the fly. We're just adapting direction that we received at the federal level and are continuing to engage consumers in a helpful and thoughtful way. With forbearance, I appreciate what's been said, and I'll stress just a couple things to finish off this question. First, your situation is unique, consumer. Your servicer is unique to who you're using as well. The number one thing is you have to just get on the phone, explain your situation in honesty and detail so that the appropriate action can be taken. But understand what you're getting into as well. What the danger out there, and one of the reasons we're on this panel right now, is the loose and general language of, hey, you don't have to make your mortgage payment right now. That's what comes across a Twitter feed. You Google it, oh, free mortgage payments. And you have to keep making your payment until your servicer enters into an agreement with you that otherwise states you do not have to make it. Problems we've seen already are, oh, I didn't have to make my payment, so I stopped making it, and you just have to take care of me. That's what the federal government said. No, I'm sorry. We were not in a agreed and executed state, and so if you took an action on your own, you were liable to that action because it was not an agreeable action with your servicer. So I really want to drive home and take away that misnomer that there's just some inherent payment waiver that's just available to people right now. That is not the case. You need to enter into an agreement with your servicer and make sure you understand the nature of that agreement. And as Andy talked about and Samantha, at the end of that forbearance, ask the questions now what your options are going to be at that time. Don't wait to be surprised what happens at the end of your forbearance in the agreement with your servicer. Thank you, Erica.
Thank you, Nick. Andy has something to add on to that. Andy, can you go ahead and give us some more information, please?
Yes. And from the lending side, the main thing is retention of keeping the borrower in the home. So we understand, so at the end of this forbearance or at the end of this situation, there's essentially a waterfall of questions that they're going to answer. So if the borrower can repay over 6 months, over 12 months to catch themselves up, what about the borrowers who are in certain industries where honestly their income doesn't come back? So it really comes back to saying, I can't even make the payments that I had before. I can't do this. So at that point, they're either, you could go into full loan mod. So if it's a loan modification at that point, and as a servicer, we see it. I mean, so we're running into this, and some of the investors are giving us guidance as to extend the loan out to 40 years, drop the interest rate and keep it at 30 years. But these are some options for loan modifications that are coming through. If at that point, then if borrowers are not able to even if they can't make that payment, then the investor could possibly be looking at liquidation. But the full intention of all the lenders here is trying to keep the borrower in the house. That's the main focus.
That's really important. Okay, we're going to go on to our next question. Samantha, would you lead us off by giving us some insight and information on deferments?
Sure. I think the main thing I want to start with, which may sound redundant again, but mainly it's knowing the difference between a deferment and a forbearance. So I've seen many people say it, or heard many people say it, and seen many people post about it, where they say deferment, and they assume they get their payments forgiven, and they're actually talking about a forbearance. So deferment is where you are skipping maybe a payment or 2 payments, and you're adding it on to the end of your loan. So the difference, to circle back to forbearance is you're skipping 1 or 2 payments, and then you may have a lump sum payment. So it's important to know the difference between the two. And then it's important to know as well, you may be charged, additional interest as you're adding to your current mortgage balance. So make sure you ask those questions again to your servicer. You can also check with some of your other like installment loans and stuff that you have. Many companies, a lot of credit unions and stuff like that, sometimes they will offer you deferment options on like your auto loans. And you may be familiar with something similar to that comes out in the mail. I know I used to work at a credit union a while back, and we used to send out a deferment option for other installment loans during Christmas. So it's pretty much similar to that payment's just added on to the end of your loan. And that's really all I have on that. Again, just ask the questions that you need, and I will send it over to Nick. Is it Nick? Yes.
Yes, thank you, Samantha. I think with any of these forbearance, we mentioned deferment, loan modification, I want to stress these are all alterations of your loan. Again, we want to get away from language that's being set out there of forgiveness or waiver. These are ways to reconstruct the loan to give short-term benefit needs, but not to excuse, if that makes sense. And so we need to keep that in mind. And before I move it on to Andy, there's one thing I want to touch on now that we've talked about forbearance and deferment, brought up loan modification and so forth. And that is the other part that's going around in the news. I facetiously mentioned, right, that the Google sphere talks about, hey, you don't have to make your payments. Yay, go with it, in a very loose fashion. The other part is, oh, and your credit won't be impacted. That's the other thing that they came out relative to the CARES Act, flexibilities, not only around loss mitigation tactics, but around credit reporting. So let's just highlight like that real quick. This part should be viewed with just great caution. All right, because creditors are used to using automated software for uploading information in mass to the credit bureaus. We don't go one by one each month and send information on a loan record to a credit bureau. So the industry's been asked to shift from, mass, extractions and sending those to the bureaus about, payment options to now having to go in and manually update. Well, across millions of loans, mistakes are going to be made, not out of ill intent, but out of human nature. And so people are going to have to pay attention to that and understand, hey, I got a late payment. What the heck? Well, you know what? It was probably a manual entry just gone awry. Again, call your servicer, walk through it. It might be a pain, that's understood. But understand this is a change behind the curtain on how we're handling credit reporting, and a change that inherently is going to bring about some mistakes. The other part too is, servicers can add remarks to their credit lines. They can say loan modified or loan deferred. And while a late payment is not necessarily being recorded, the credit score may still be impacted because the algorithms the bureaus use in certain models pick up those remarks and recognize those as issues that can take a hit on the credit. So I just want consumers to be aware it's not a fail-safe situation what the CARES Act extended relative to credit reporting on these deferments, forbearances, and so forth. And again, ask your servicer how they plan to handle this. Not just the forbearance or maybe the deferment itself, but how do they plan to handle the credit reporting? Do they add remarks? So again, to try to alleviate any surprises at the end, this is another great question to ask, supplementary to the agreement that's being discussed itself. With that, I'll turn it over to Andy.
And thank you, Nick. And in addition to that, there's been a couple articles that have noted that the annual credit report is now accessible once a week. You can pull up a free credit report to monitor your credit. I'm going to be real careful and not say the website, just so you guys do your research. I think it's annual free credit report, but please do the checking. But it's been on a couple of things that I've read too. So if you want to monitor your credit, you can on a weekly basis without cost. Just going back to the deferment, we were, I know I've talked with our servicing side, and in cases in the past, I'll talk about FHA and then I'll talk about Fannie Mae. But FHA generally if there is a deferment later on, and like we've talked about it, and I'm not saying that it's not it's certainly not there now, but it could be at a future date when they talk with the investors. FHA usually, at least when I was talking to our servicing, generally issues a note and a deed of trust to the Secretary of Housing, and then the borrower signs that, and then whoever the servicer is files a claim. And so upon the sale of that, that's when it's paid back. Fannie and Freddie, probably close to the same, but its possibility of adding it back. This is sometime down the road, and it, again, like it all comes back down to the servicer. Please make the servicer aware of your situation, and each one is unique, and the investors as well. With that, I'll give it back to you.
Thank you. Thank you everyone for your insight into deferment as an option for homeowners during COVID-19. Honestly, you all provided a very different set of information that is just so helpful to our guests, and I can't tell you how much I appreciate your time here. Before we wrap up, I have one final question for all of you. What thoughts would you like to share with our Reno Sparks Association of Realtor members about the short-term outlook of residential lending in our market? And Nick, could you please go first?
Yeah, thanks. And with this being our last question, let me begin by thanking the Reno Sparks Association of Realtors and you, Erica, for having us on. I really appreciate that and giving us the opportunity to try to straighten out some things that people may be hearing. And a special thanks as well to Samantha and Andy. It's been a pleasure being on the panel with you. You know, we've talked about refinances and also impacts and options on making mortgage payments, but this is an RSAR panel. So let's talk a little bit about the purchase market to end, as I know that that is very relevant for you all. You know, the basics of economics are rooted in supply and demand, right? While our area has gone through some supply deficiencies that we know, one thing that is happening right now, though, is pent-up demand is building. There are people waiting to get back out on the market from a purchase perspective, and I'm excited about that. You know, employment and consumer fear are going to be the primary potential causes of resistance as we come back into the purchase market, but those are largely seen by industry leaders as things that will be overcome and not genuine impasses to reinvigorating our purchase market. You know, in the end, I'm confident in my fellow industry leaders in this area. We've been through much over the years. Andy mentioned, you know, 2006. That's, of course, notable as something that we all got through, you know, together in our diligence and our professionalism and so forth. You know, and during times like this, you know, negative people will see the obstacles. Positive people will see the opportunities that present themselves as we come out of this pandemic and we start to open up our markets. And I'm confident that our housing industry in Northern Nevada will persevere accordingly as the market begins to open, because I have seen firsthand for almost 17 years what we are capable of here in the Reno Sparks area. And I know the professionals that we have, I know the professionals that are listening to this will agree that there is far more to be excited and positive about once we exit out of this market and reopen it than there is to be feared. And I'm looking forward to our market reinvigorating itself, and I'm confident that it will. With that, I'll turn it over to Andy.
Thank you, Nick. Yeah, in addition, I mean, optimistic, yes, extremely. And the bank is focused on getting back, you know, carrying on the business at hand. We are well prepared and the market is strong. You can feel the pent up in, you know, what's there. I'm talking to borrowers, I'm talking to people, I'm talking to real estate people. And so they're out there. I know that the inventory is a little bit down and such, but boy, is there, I can feel it going on that. And with all the concern on this virus, man, stay safe. God bless everybody. And but at the same time, we're going to come out of this, and we're going to come out of it strong. Thank you very much for having us.
I think Nick and Andy, you said it really well. I feel very confident about what will occur after this is over. I think the main thing to keep in mind is that we're the professionals. We're going to let you know if we start to see some sort of a dip and slide in the market. And I know we all reach out to you with updates on a regular basis. I myself, and I know Nick and Andy, are super busy right now. We have a ton of business coming in. There are definitely people wanting to get pre-qualified. There are investors still buying homes. Has it slowed down a little bit? Yes. Have we lost some deals because of this? Yes. But the calls are still coming in. And during this time, it's important to just keep pushing forward. We want to keep reaching out to our clients. If you have clients that have been affected by this, you know, that were purchasing and maybe they can't now, it's still a good time to keep in touch with them, work on them, get them to where they need to be so that when they can return to work and they are in a position to buy, we can help them. And I really appreciate the opportunity to be here. Nick, Andy, it was a pleasure. And Erica, thank you so much.
Oh, thank you for those closing thoughts on short-term lending in our market and your sentiments. I want to thank my guest, Nick, Andy, and Samantha, for joining me today to talk about options for homeowners who need help during COVID-19 with their mortgages. We'll have more information from all of them on our website. We want to remind our viewers that the information provided by our guest today is for informational purposes only and does not represent other banking and mortgage institutes. For specifics or questions regarding your own personal mortgage, you must reach out to your lender banker to determine what options are available to you or your clients during COVID-19. Thank you again to my guest. Thank you for joining us for today's episode of Conversations with the President. Until I see you next time, have a wonderful day and please be safe.